Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on the 17th of December, 2019. I do want to remind you, I'm the author of Jay Taylor's Gold, Energy, and Tech Stocks. It's a letter that focuses on the junior mining companies, some of them that you hear about here on this show, but that's only a small number of the companies that I cover and follow very closely. Very exciting times now, as these companies are finding significant amounts of gold in the ground. We'll be talking to Chris Taylor in just a little while. Today, Great Bear Resources is one of the most exciting stories that I've covered in all of the 35 years, I think it is about, that I've been writing my newsletter, a long time, and this is one of the more exciting ones. So Chris will be with me a little bit later. I'd like to also remind you of Chen Pix, chenpix.com, and his letter is What is Chen Buying, What is Chen Selling? Go to chenpix.com. To sign up for Chen's letter. Michael Oliver is with me today, olivermsa.com. You need to go there as well, and Michael will be with me in just a moment or two. And I do want to thank all of you for listening to this show and making it one of the more popular shows in the Voice America Business Channel. Also, encourage you to keep your comments, whatever they be, positive, negative, or whatever. Send them along to questionsfortaylor@gmail.com, questionsfortaylor@gmail.com. I also want to thank our sponsors. Without them, there would be no show. Today's sponsors, Irving Resources, Novo Resources, Great Bear Resources, Gatling Exploration, and TriStar Gold Resources. I've titled today's show, Euthanasia of Capitalism by the Federal Reserve Bank. Keith Weiner, Michael Oliver, Chris Taylor return today as my guests. John Maynard Keynes said, and I quote, "There is no subtler, no surer means of overturning the existing basis of society than to debauch the currency. The process engages all the hidden forces of economic law on the side of destruction, and does it in a manner which not one man in a million is able to diagnose." End of quotes. Most suggest Keynes was speaking in that quote of inflation as a destroyer of society, but my guest during the second hour today, second half hour, is Keith Weiner. He argues that Keynes really meant he really had in mind declining interest rates were the destroyer of society. We will ask Keith why he thinks manipulation of rates, the declining rates under Federal Reserve manipulation, is the death knell of capitalism. Regardless of what was in Keynes' head, Keith will make the case as to why he believes that the manipulation of low rates is really causing us a lot of harm and a lot of future grief. That message should be loud and clear from the self-inflicted destruction of the Soviet Union and Mao's China. In order to survive, both countries have had to revive at least a form of capitalism rather than the kind of socialism for the rich that the Federal Reserve seems to be peddling. So in the second half of today's show, I will ask Keith to explain all that. Certainly one of the ways that we want to try to protect ourselves from the incoming destruction that seems to be heading our way is that we want to own gold, that's for sure, and Keith will talk to us about the programs that he has with his company that can help you actually earn a reasonable rate of interest in a safe manner with his company. But certainly investing in companies that discover major gold deposits is another way that you can preserve wealth. And again, as I mentioned, Chris Taylor will be with me in just a few moments after our first commercial break. Certainly, that company's Dixie project in the Red Lake District of Ontario is one of the most exciting gold discoveries that I have been following in all these, it's actually now, I'm come to think of it, about 38 years that I've been writing my newsletter. So we'll be talking to Chris right after our first commercial break. But right now, I'm really pleased to tell you that Michael Oliver is with me once again. Thanks for joining me again, Michael.
Hi, Jay, and it's a good time, actually.
It's a good time, and, we're not having you on every other week, and because you sort of felt that, it gets a little stale. It's the same thing every week, but it's not, of course, but now every other week. And this week you have a couple of markets that you're really watching closely that you think are probably going to be important with respect to gold's next move. Talk to us about what markets those are and why you think they're so important, and where are they now in terms of the major turning points for those markets?
Well, the two are the two quietest markets for the last year and a half. In other words, where their price range was measured in single-digit percentages, in narrow single-digit percentages. That would be the Bloomberg Commodity Index, which hit its low in 2016 and then since has gone to sleep, and the dollar index. Well, everybody touts emotionally the firm dollar. If you actually look at it and go back to August of last year, which was the end of a rally for the dollar, 97, well, that's what we're trading now. Okay,
yeah.
We've been higher. We've been up in the low 99s and been down in the 96s, but it's extremely narrow range for a major asset like that. Same is true with the euro, the inverse of it. Then the Bloomberg's been extremely narrow. So those are the markets that nobody's paying a lot of attention to because they're not deemed to be a factor. Mm-hmm. So when foreign investors come over and buy U.S. stocks or any other assets in the U.S., of course, they're effectively have to buy them in dollars, so they have a dollar exposure.
Right.
To their portfolio. And that has not been disturbing to them. So as the S&P goes up, the dollar's hanging in there, so that's not a factor in their sense of their safety. Now, the dollar, I think, is about to become a factor in the sense of their safety. It's dropped early this quarter from the 99s down into under 97. Right now it's back above 97. But it's below certain key levels that we defined early in the quarter. If you close the month, any month this quarter or the end of the quarter, December, below a certain number, as far as we're concerned, the downside is beginning again. And those numbers will actually adjust upward once we get into January. Mm-hmm. So if you don't break them at the close of this month, and you're below them right now, you'll likely break them next month. Mm-hmm. So we think those triggers are going to be pulled, and the dollar is going to wake up to the downside and make a lot of noise and become a factor. Inverse of that, almost exactly inverse to that, if you overlay their quarterly momentum charts, is the Bloomberg Commodity Index, which for the last year and a half has been confined below its three-quarter average, mostly. Never closed a month above it. We're above it now. And we only have, a handful or so trading days left in the year. So it looks like it wants to have an upside breakout. And this is not narrow. In other words, it's not just as oil's up. Copper's also up sharply. Grains are moving up. Soft commodities, sugar, cocoa, moving upward. Gold's already moved up. We know that it moved up $400 in a year. And silver's moved up nicely. And they're sitting there waiting, we think, the leadership markets, gold and silver, for wind at their back. They did not need any wind at their back over the last year, from August 2018 to August of this year. They did it on their own. There was no commodity price inflation, et cetera. But we think they're now going to get that wind at the back. They're going to get headline stories about commodity price booming and the dollar breaking down. So suddenly there'll be new factors that the public can sort of appreciate and likely move more money into the gold market. So we think this is very much a replay of the stagflation era of the latter half of the 1970s when we had 6% to 9% unemployment, oscillated back and forth. The world economy basically was flatlined, and we came out of recession in 74, 75, but you really never recovered. And yet markets like copper tripled in price. Gold went from, a low in 2000, in 1976 at just above 100 to went to 850, et cetera, and it was across the board in commodities. So we think that's about what's going to happen in terms of asset class shift.
One from a fundamental point of view, why things happen. But I couldn't help but notice an article, I just read this last week, that 90% of the new Treasury borrowings since September have been financed by the Fed. In other words, printing press money. And the central banks around the world are talking about how they want to generate more inflation. So they seem to be telling us that come hell or high water, they're going to make sure prices rise. Commodity prices, equity markets have risen like mad. So I guess you're really, on the equities, you're not so, you think they're very vulnerable at this stage, right?
I think the equities are, first off, they're a dog. Even taking the S&P, which is the strongest broad index in the developed markets. If you objectively don't listen to the news that says, we're up 25% this year, of course you are, because you had a collapse last year. You came from the lows, okay? If you go back to 2019, to the high of 2018 in January, so almost 2 years ago, we were 2,800 plus, okay? Now we're at 3,100. Well, there's an angle across the highs from early 2018, September 2018, and the highs we made earlier this year, that we've gotten above that angle a little bit. It's what I call a blow-off. But that angle rises at 3% annual rate. So since 2018, we've risen at a 3% annual rate on the S&P if you look across the highs. So it's not a booming market. It's a stagnant, slightly rising market, which is evidence of distribution. In other words, somebody decided a couple years ago that the risk-reward ratio of owning stocks was not that good, and they began to divest from the market. Quite often this occurs. It happened in 1929, happened in 87, where you had a premature top, and then a burst at the end that took out the distribution zone, and people thought, oh, a whole new leg is starting.
Yeah.
I think that's where we are now. Now, at the same time, what have commodities done? They've not gone down. They ceased going down in 2016. In fact, they're well off those lows. Admittedly, it's sideways, but it's somewhat reflective of the sideways gradual rise in stocks. You've had a non-event sideways in the commodities. We think that's evidence on both sides of accumulators in commodities and distributors in stocks. And we think this is a snapping point for both.
Right. Well, it's a key time. No, it would really seem that that's the case, and very, very bullish for, I would think, for gold ultimately. But what will really surprise people is if we start getting some inflation in the form of commodity prices, I think, because no one's really expecting that, as you say. Nobody's expecting those.
The first leg to be something on the order of 30% rapidly within a couple quarters, if we trigger our numbers, which we're slightly above right now. So that will be a shock effect.
Well, this is the value of Michael's work. I might just tell my listeners is that he sends out these missives throughout the week or whenever they are important to let people know when key areas are being violated or being taken out. And that's very important. And Michael, I understand that you have a special report coming out today on copper, which you're turning very bullish on, right?
Oh, yes. Copper is fully participating. It's beating its chest, and they like to attribute it. Wall Street Journal said the other day it was because of the economy is getting better, et cetera, et cetera. I take the opposite of that. I think this is the late 70s.
Unfortunately.
It's Federal Reserve at work.
All right. Well, it's okay. Well, it is what it is, and we have to protect ourselves as best we can. It's OliverMSA.com, OliverMSA.com. Go there, folks. Sign up for Michael's letter. If you're an investor of any size, you won't be sorry that you did. Thank you, Michael, for being with us, and we'll look forward to talking to you in a couple of weeks in the new year.